you can find every bubble, people tell a story of why it's not a bubble.
Right.
You're in the real estate business, don't have to explain this to you, but you can
Hmm.
go back to the railroads, the steam engine, Florida land, many, many things. And the internet bubble at the end of the 1990s into
Hmm.
2000. And now we have an AI bubble. And there's always truth to it, but sometimes there reaches this degree of euphoria where
Hmm.
they just say, well, the world has changed. Nothing is the same.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast YouTube series, Real Estate Market Watch Current Events Through a Real Estate Lens. My guest today is Professor Kenneth Rogoff, who is the Moritz C. Boas Chair of International Economics at Harvard University and one of the world's leading authorities on global macroeconomics and financial crises. He is a former chief economist of the International Monetary Fund, and his research spans sovereign debt, exchange rates, monetary policy, and long-term growth. He is the author of This Time is Different, which is a book about how hundreds of years of financial history reveal recurring patterns of debt, banking, currency, and sovereign crises, showing that economies repeatedly convince themselves that this time is unique, even as they follow the same cycle of excess and collapse. His most recent book is Our Dollar, Your Problem, an insider's view of 7 turbulent decades of global finance and the road ahead, published in 2025, which examines the rise, dominance, and potential future challenges of the US dollar in the global financial system. Professor Rogoff appears regularly on major media and advises policymakers and institutions worldwide. And his work focuses on interpreting global economic risks and the structural forces shaping markets, capital flows, and geopolitical dynamics. And it is leaning into both of these books that our conversation goes today. I'm sure you're going to find it very interesting. And if you have not already done so, please go to gowercrowd.com and subscribe to my newsletter where I produce summaries of these conversations for you so you can read them as well as listen or watch to them, all there at gowercrowd.com. Okay, let's move on to this holiday special edition of Real Estate Market Watch with Professor Ken Rogoff of Harvard University coming right up. Professor Rogoff, Ken, if I may, thank you so very much for joining me on the podcast today. I'd like to start our conversation by reading from your latest book, Our Dollar, Your Problem, an insider's view of 7 turbulent decades of global finance and the road ahead. And actually, before I ask the question, I love that you've called it an insider's view of 7 turbulent decades. So I figure that you must, your inside view started when you were around 2? Or...
Well, I was certainly watching my neighbors build bomb shelters back in Rochester, New York, and that's part of with the Russians. But yeah, I mean, I think that's just looking backwards, but certainly by the late 60s, absolutely.
All right, so I'll remove tongue from cheek now as I ask you the question I'd like to ask. You've argued in the book about the dollar's dominance being no longer assured. So what are the forces most actively eroding it today? More importantly, why should American consumers care?
Well, let me start with the last one, which is a real low-hanging fruit. American
Okay.
consumers and businesses, which is fundamentally we pay lower interest rates because of the dollar dominance, because the rest of the world holds so many dollars. It creates a bigger pool of demand for our bonds, and it probably lowers our interest rates by 1%, not just to the government, but on mortgages, commercial real estate loans, everything, um, given how much we borrow. So it's not saying that we pay a lower rate than Germany because they borrow a lot less. But if you think of the demand curve we face, given how much we borrow, we probably pay about 1% less. But I mean, there are other things which would take, we can come back to having to do with the flow of information in the world.
Mm,
Because the dollar is so central, we have the back office, the plumbing of the whole global financial system running through our backyard. We can see incredible amount of things. A lot of our spycraft actually is our financial system. And of course, more conspicuously, we use it for sanctions. So I mean, it prevents us for going into wars, sometimes being able to use it. And I could go on and on about this. It's very, very, very valuable. The things eroding in them, it's important to understand that it's not like just a natural thing how much of the market you control. It's one thing to be on top. It's another thing to have the size of the market share that we reached 10 years ago. I think that was when we hit our peak. It has
mm,
ups and downs. So actually, most of our foreign market in 1971, that's where the book's title comes from. We can come back to it, but most of it was in Europe. They were all holding dollars. They were holding dollars the way Asian central banks are holding reserves now.
mm,
Europe's gone. Europe's not in the dollar block anymore. They're in the euro block. And so this isn't a static thing. What I would say been going on most importantly since about a decade ago is the Chinese just can't go along with this game anymore. They probably
mm,
stayed with the dollar too long. China's half the dollar block, believe it or not, China, Asia is half the
mhm,
dollar block. And as China withdraws, we're going to lose some of that market share. So that's one thing. And I think another thing is the fact it's great to have sanctions. Fantastic device, financial sanctions. We did that to Russia. I think all your listeners know about that. We actually have it on 20 different countries at the moment. And maybe here and there prevented us from doing a military action that we would have done otherwise. That's great. But you start using it so promiscuously, it causes people to want to diversify. And it's not just China, but a lot of countries want to diversify because they don't like the sanctions. Those are the pressures from the outside. That's been going on. The dollar's position's still very strong, but not like 10 years ago. The other things are on the inside. We uh, are drunk on debt and are
mm,
convinced nothing will ever go wrong. And I'm particularly talking about public debt, but it's also private debt. And so, as people have been saying that for a long time, but the debt's gone way up now,
mm,
and interest rates have gone up. When interest rates were zero, real interest rates were zero, who cares? They're not. And we can come back to it, but I'll venture that they're not going to be for a long time. And then finally, a cornerstone of dollar dominance of our whole system is confidence in the Federal Reserve that we're not going to inflate. Because, of course, the title of my book comes from when Nixon abandoned gold. Believe it or not, and I think most people never really thought about it, but the
mm,
dollar was convertible to gold for us as individuals until the early 1930s. FDR went off that. But countries in the 50s, 60s until Nixon, they could still convert their dollars to gold. And believe me, that meant a lot to them. And then in 1971, Nixon abandoned that. That was a very, very big deal. We can come back to it. And we floundered in the 70s. We didn't have a way of dealing with it. We eventually came up with this idea of an independent central bank. Actually think I wrote the first paper about this.
mm,
And it's not the only way to do things, but it works. It works in the United States. It works in emerging markets. It works amazingly well. That independence is being eroded. This isn't a Trumpian thing. The progressives hate central bank independence. In fact, they don't even like banking. So they don't even like banks. And so, it was coming. It was coming. In fact, my book was finished before I knew who would win the election. And I go on and on about how the progressives want to get rid of it. I deal with them a lot being a
mm.
Harvard professor. So
Mm.
they're just like ancient Rome, they're the tribes on the outside pushing in, but there's also sort of problems on the inside. They're not unsolvable, but like many things of anyone following our political system, we do a lot of things well and we do a lot of things stupid. And it's a contest between which one will win.
Okay, so help me understand this. My audience is very sophisticated and knowledgeable. I am not. So I'm going to ask some dumb questions if you don't mind.
I'm
What
sure they
is
won't be, but go ahead.
Well, so talk to me about the importance of an independent central bank. Why is that important? What are the cases for and against that?
So something that most people don't understand, your audience is very sophisticated, so probably they understand. But I would say I can go around my economics department, and I'm not sure all my colleagues would understand this.
Mm.
I know my students wouldn't. I know lawyers wouldn't, ordinary people.
Okay.
Everybody thinks the central bank controls interest rates. That is false. All the Federal Reserve controls is the overnight interest rate. It floods the market or starves the market with its own debt to control the 1 day interest rate. It doesn't control the 10-year interest rate, which is the bellwether of our financial markets. It doesn't even control the 1 month interest rate. Now, it's true that when people are thinking about, well, what should the 10-year interest rate be? They're thinking about, well, what is the Fed going to want to do? But that's not a simple question. So right now, as we speak, there's a lot of pressure on the Federal Reserve coming from the president to push rates down and down and down. The
Mhm.
short rate, that's all they control. But the trouble is, if the markets think that's not going to work and it's going to lead to inflation, long rates will go up. And so the independence of the Federal Reserve is actually a way of solving that problem. Governments always want lower interest rates. They're always pushing for lower interest
Well,
rates.
especially real estate developers, as we have in the White
Well,
House.
real estate developers, of course, but everybody wants lower interest rates. Car buyers, everybody wants lower
Mm.
interest rates. And you can get them for a while by pushing them down. But the trouble is, if inflation goes up in a big way, or even let's say 4 to 5%, it can be very painful to bring it down. I mean, goodness, we started trying to bring inflation down in 2022, and it's still closer to 3% than 2%. And I'm old enough, and the book talks about it in the 7 decades I'm talking about, to live through the 70s.
Mm.
And it was very hard to do. It was very heavy lifting. So that's the balance of how do you want, in a way, you want the Federal Reserve to represent the people. You want it, if the government wants something, you want to give it. But there are times when democracy creates pressures that aren't great. I'm sort of free associating, but
Stop.
in back in ancient Greece, they used to have lots of questions about the battles, and they used to do everything by democratic vote. So now, of
Mhm.
course, democratic vote meant a few rich people, no women, no slaves, et cetera. I mean, a couple thousand people. They'd get around and vote on what to do.
Mhm.
And it dawned on them that this was in Athens. It wasn't working so well in their battles with Sparta because they were slow, and they finally got the idea of, let's have, a general, let's have an admiral make these decisions. We'll delegate it. And it's
Mm.
analogous. I mean, there are times when you want to do that. You want to tell the admiral, the general, we want to be fighting Sparta. We don't want to be fighting somebody else, but it's in the same spirit. That whole idea, I have to say, is really under challenge at the moment. I'm sure everyone's following this, but the question of, can you have independent agencies? Uh, President Trump is trying to push the idea that the executive should have total power, and I personally think that's going too far. There are things, the Atomic Energy Commission, would be an example where you kind of want to leave it to the experts. I would say vaccine policy
I
also.
was going to say healthcare.
Yeah, where you kind of want to leave it to the experts. And yeah, you look at who you appoint, you revisit it every once in a while. That's what we've done with the Federal Reserve. And the problem is the Federal Reserve is so powerful with its interest rate policy. This temptation is enormous, and we'll see what happens.
I've always thought of, all right, so I have a limited understanding of this. My PhD thesis revolved around a world that was before the central bank, which was formed in 1914, I think. And I've always thought of it as being its most important function is to be the bank of last resort. How does that fit into this? When there is a financial crisis, they're able to step in, and if it's not independent, what's the implication of that if there is a
Yeah, so
crisis?
so we used to be on the gold standard,
Mm,
and being the central banker basically meant somebody comes to you, you pull some of your gold out, and you take the cash in, or vice versa.
mm,
Okay, I'm exaggerating. There were some other decisions, but this whole notion that some people have that central bankers caused, all these problems over history, that's a more modern thing. They didn't, the big instrument they have is the interest rate. So you're absolutely right. They had other things they did where they would provide credit in a way. They
hmm
would have the government's credit back somebody. That's how we
mm,
would stop banking crises. Back in the after the Civil War, the government moved to try to stop all the banking crises we were having,
hmm
and it turned out to be a good idea. It improved things, but it wasn't managed very well. And that was really the reason that the Federal Reserve was formed. So we need a centralized bank to try to do this instead of having the Treasury manage it on an ad hoc basis.
Why do you think Americans underestimate the risks associated with the central bank and the impact on dollar dominance?
I mean, people don't think about it. I mean, to your crew who's listening here, Jay Powell's a celebrity. In fact, the whole list of people as we speak, it could be decided any day, who are replace him, they all know the names.
Mm,
Nobody does. I mean, if I were to go around, and frankly, I mean, I teach brilliant students at Harvard, and I were to ask the ones who are English majors or something else, and
right.
frankly, a lot of the econ majors, who's the head of the central bank? And I
Mm.
gave them three or four choices. You know, there's not a guarantee that they're going to get it right.
Right.
So it's just there are these things you don't want. You notice it when your
Mm,
grocery prices are going up. I notice it when the
mm,
grocery prices are going up. You don't want to know how they're doing it. You just
mm,
want to know that things won't change too quickly. You can kind of count on some stability. You're not looking to understand every little detail. And there's more than one way to skin a cat. China
mm,
has very low inflation, and they sure as heck don't have an independent central bank. Uh, but it can be done. But it's been a good device in our democracy for doing it to try to resist that temptation to push, push, push. I mean, one of the things I love about Donald Trump is he says things so bluntly that other
mm,
presidents were thinking. So there's no filter there. He just says it. I want
mm.
interest rates to come down to 1% back when they were 4.5%. They should be 1%, which I guarantee you other presidents were thinking. He actually says it. And okay, maybe, but if we're not having a big recession and you try doing that too quickly, you're going to have demand explode. And again, I don't have to tell your people that. And so, the truth of the matter is the Federal Reserve, our central bank, is seeking to stabilize inflation. And they don't really know what path of interest rates does that. They're guessing, just like the market's guessing. They're feeling it out. They don't really control the interest rate over the long run. If that's their goal, if they're really not willing to give up having, let's call it reasonably stable inflation, they just got to go to where the market takes them. And if they try to do something vastly different, they'll get burned. Not overnight. So if the Federal Reserve starts cutting interest rates too much, we aren't just suddenly going to get crazy inflation. We may get a lot of action in real estate, but it's not going to happen in the whole economy. It'll take time. But over time, it will build up. And then for the same reason that it doesn't change quickly in one direction, it won't change quickly in the other direction.
Let's talk about debt a little bit. You mentioned debt.
Mm-hmm.
And and just to drift slightly into the world of commercial real estate, if you don't mind, you've talked about, or you've warned that the office sector weakness and commercial real estate refinancing pressures can transmit risk into the banking system. So, how big is that risk, do you think, to the broader macro picture today?
I mean, I don't think it's a systemic risk, as we call it. I don't think
Mm-hmm.
it's a thing that's going to bring on another financial crisis. For
Mm-hmm.
one thing, it moves slowly. It's not an all at once thing. The refinancing, it's not like bank deposits where they all get pulled out overnight and everything hits. So it's slow. A lot of it's held in hedge funds and in outside the banking sector. And so if they lose money, some people will lose money, but it's sort of diversified. But yeah, certainly, if we have interest rates rise more than they have and stay higher than we have, we're going to see a lot of places have trouble. I mean, whenever something happens we're not expecting. But yeah, for sure, the banking sector ultimately holds a lot of this debt because even if a hedge fund has it, they get loans from the banks. And so it all sort of comes back to them. But I regard it as a very important risk for the health of the economy, but I wouldn't quite put it to say we're going to have another 2008, 2009. I don't think that's in the cards. Much more likely, if we want to put it risk, is getting at some point in the next several years a burst of inflation. That's a much bigger risk.
Interesting. Well, so layer on top of commercial real estate the debt that is flooding into AI development. Does the combination now start to pose a systemic risk, do you think?
Well, I have to say, it's not just the debt going into AI. It's
Mm,
the share of the stock market, for example, the share of growth. And
mm,
one of the reasons the US economy has held up so well, it's been remarkable because I think we've done a lot of things in the last year, and even frankly in the 4 years before that, which were probably undermining long-term growth, gently undermining long-term growth. I mean, slowing down immigration, stopping immigration. Biden had too much, and it was very illogical immigration. That was crazy. We've gone in whole hog in the other direction now. This immigration is very important to the U.S. Business model. Half of our Fortune 500 companies, almost half, were founded by immigrants or immigrants' children, and we're very dependent on it for our dynamism. And if you cut it out, it'll have a problem, but not right away.
mm.
Putting on tariffs, it's not the end of the world, but like any tax, it's bad. It slows growth. You can make it up in other ways, but there are a whole bunch of things we can talk about that are sort of low frequency, low grade problems that will cause a problem, but not right away. But people look at the economy. It's still, knock on wood, because it could change very fast. It's still doing great, and or solidly at least. I mean, Chair
But
Powell says
Professor,
Chair
yeah.
Powell says he doesn't know, and AI is behind that. So if
Mm,
we could have a bursting of the AI bubble in 5 years, but it can happen in 5 days. I mean, it could happen. And then the
Yeah.
loss of confidence, the loans, the drop in consumer spending, it could be huge. I mean, AI is at the center of the dynamism in the economy. It's at the center of the stock market, but it could go into sharp reverse.
Um, the Okay, somebody just walked in, so it's not my focus. Briefly, but so you talk about the economy being strong, but the economy is very skewed, isn't it? You've got the top, depending on who you talk to, 10, 30% really driving the economy. And then this middle band and the lower band is actually not experiencing a strong economy. So how does that feed into this idea that we have a strong economy and that, a bubble might not burst and really crater it when it comes to AI and these core companies that are really driving the markets?
Well, a bursting of the AI bubble would be a pretty spectacular event. It would hit everybody. But
Mm,
absolutely, I'm not really talking about inequality here. So
mm,
inequality has grown a lot in the
mm.
last year because the wages have not gone up really much above prices. People, I want to say in the bottom 30%, 40% perhaps, are not really feeling great. They had been doing well, actually, and for some time before that, but they're getting pretty anxious. And the upper, I want to say 60%, not just 1%, it's much more than that, are feeling pretty good. And so it's not equal. That's a separate problem. Uh, but when we're talking about the economy doing well, there's a lot of inequality in Germany, and they're having a recession the year before. The year before that, this year looks bad. I mean, if you have a choice, it's better to have growth and then try to figure out ways to share it. I mean, it's a separate problem. So I don't want to claim we're solving inequality. And ironically, because obviously President Trump was so successful in campaigning really to try to deal with bringing good jobs back. We're going to have these great manufacturing jobs, but at the same time, he's fueling AI, which is getting rid of a lot of pretty good jobs, white collar jobs. And but I mean, he didn't invent AI. That's sort of something going on that's a much bigger arc of history.
In the context, and just getting back to the dollar in this conversation, in the context of the dollar and exorbitant privilege, are there any? I've listened to a lot of your stuff, by the way, and I do have a question to follow up with on this.
Mm.
Specifically, nobody's asked you, at least not that I've heard anyway. I'm sure they have, but I just haven't heard it. But in the context of exorbitant privilege, are there any systemic risks from the decline in demand for the dollar and deglobalization and all these factors that you're talking about?
Oh, well, I mean, of course there are, because even with interest rates a percent lower than they would be, we're having trouble. Our interest payments are now, I think, the second biggest item in our budget.
Hmm.
We don't seem to have any political will to close things up. Plan A, B, and C is to have AI save us. So I think we often, I mean, Scott Bessent, the Treasury Secretary, is very good, points to the 90s. And it's true, the internet made the 90s. Clinton and Bob Rubin and Larry Summers did a
Mm.
good job, but the internet did it. So he said, we're going to be the 90s. Oh, okay, maybe, but we might be the 80s, we might be the 70s, we might be the 2010s. The 90s was an anomaly, and it didn't last indefinitely.
Hmm.
So, we'll see. I mean, AI may save us. It may destroy us too. I mean, the highest use of AI, I mean, there's a big use of AI in warfare. There's going to be lots of social problems from the mass job losses. But yeah, that's our plan for dealing with the debt. We're not mentally conditioned. We haven't had to. But I think part of that is interest rates have just been dropping and dropping for 40 years. Nobody's worried about debt since Clinton did in the early 90s when his advisors said, look at interest rates, long-term interest rates, they're pushing up. Every time you talk about all the great programs you're going to do, interest rates go up. You better think of something else. And he did. But people think that's never going to happen again. And of course, that's a significant risk.
So this question that I've not heard you asked is this idea that the weakening of demand for the dollar and all these factors that we're talking about. One of the reasons that I get a sense that people don't really appreciate how important that is the time scale. It's not something as we see this progression or this progression of weakening in demand and etc. It's not something that's going to impact us next year necessarily or the year after. What is the time scale? What are we talking about before it really does start to have a negative deleterious effect on the economy? Noticeably so.
Well, it's happened a little bit already. It's part of why
Mm.
our interest rates have gone up. Not the whole thing, but maybe a 0.25% of why our long-term interest rates have gone up has been that there's been more diversification from the dollar. So you mean it's a rounding error, in some ways. But
Mm.
then if you continue at that pace and you go over a decade, it adds up. I would say one thing to remember is now, today, we have become the world's biggest borrower, biggest public debt, biggest corporate borrower. Wasn't always so. We
Mm.
are now. And one thing that's happened worldwide is that interest rates have gone up. And if you're the world's biggest borrower and
Mm.
interest rates have gone up, that's not a great position to be in. We haven't really been caught in the crosshairs before. We had periods where interest rates were high, but our debt wasn't high, and our debt was going up, but then interest rates were practically zero. I went around the world debating famous other economists, Paul Krugman, Larry Summers, that they said interest rates are never going to go up, and I said and therefore debt is free. A lot like modern monetary theory, but slightly more sophisticated. And I said, yeah, maybe you're right, but do you want to bet the farm on that? Because we've had this before where interest rates were really low until they weren't. And so that's what's different now is that interest rates have gone up and our debt's high. And if interest rates don't come down, which is, I must say, I hear Scott Bessent's plan, Donald Trump's plan. Maybe they're right. Maybe interest rates are abnormally high. And when investors wake up, they'll just see interest rates should be lower. But I think the odds that long-term interest rates will stay the same or go higher are at least as significant as that they'll go down.
And that is well, that's the point I'm making, right? If our national debt is so high and interest rates remain high, what is the timescale for meeting our maker, so to speak?
I think these things tend to move when there's a big shock and
Mm.
everybody wakes up to that there's a problem. So in 2809, during the global financial crisis and afterwards, we borrowed 30% of GDP in a heartbeat, very fast. In the pandemic, 20% of GDP. The whole world looked at us in awe that we did that. How can you do that? Even countries like, say, Australia, Britain, France, even maybe Germany could have. But most of the countries in the world look at that and say, if we did that, the markets would start worrying and push up our interest rates. But I think, we've reached a point where interest rates are higher, debt's higher. Another major point of vulnerability is our politics are very, very paralyzed. And we get hit by the wrong kind of shock. I don't know what. I mean, they're these, black swan events
Right.
that just come. That probably is what will happen. I mean, one very possible one's a war of some sort. That's something that pushes interest rates up. It's very expensive. I mean, I hope it's not a world war, but certainly it's not hard to imagine something scaling up, for example, in the Straits of Taiwan or something like that, that turns out to be very costly to deal with. And that's when, oh my gosh,
Mm.
we can borrow. It's not that we're not going to be Argentina where the market just won't lend to us all of a sudden, but the interest rate starts going up and it starts getting what was the number two thing on our budget, not only gets to be the number one, but by far the number one. And markets are just pushing interest rates up if they see no reaction. That's when the rubber hits the road, so to speak. And I think the odds of that happening in the next 4 or 5 years are greater than 50%. Why? Because we're just not going to do anything until it happens. There's no politician can stay in office or get elected by campaigning on trying to lower our budget deficits. It's just not possible. We're going to need to see a crisis. This isn't a Democratic thing. It isn't a Republican thing. It's both parties. I mean, if they're not in power, they're all for balancing the budget. But the party that's in power is not. And I think it'll take a crisis to change our mentality.
Okay, I'm going to segue into another of your books, one that I read some time ago, if you don't mind, by telling you that when I first, came of age and was working in the commercial real estate business or industry in the 1980s, one of the terms that I heard was, "This time is different." They told me this time is different. It was my first venture. It's like, different than what? I had no frame of reference at all. And so your book, This Time is Different, 8 Centuries of Financial Folly. Let me ask you a really open-ended question, if I may, to dovetail into our conversation so far. What is the driving thesis of that book, and how do you see the patterns playing out in today's economic environment?
Well, I mean, the main thing the book did
Mm.
was put together data behind the idea. Before we wrote our book, all the books on debt crises were, saying the finance minister of Mexico was sweating bullets when he had to call Paul Volcker and
Right.
tell him that he couldn't
Mm.
pay. And then, President Reagan was very upset. I mean, that was like what all the books looked like.
Mm.
And we translated this into how does it work quantitatively? Like how does it look? What do financial crises look like? But of course, the psychology of it is people, you can find every bubble, people tell a story of why it's not a bubble.
Right.
You're in the real estate business, don't have to explain this to you, but you can
Mhm.
go back to the railroads, the steam engine, Florida land, many, many things. And the internet bubble at the end of the 1990s into
Mhm.
2000. And now we have an AI bubble. And there's always truth to it, but sometimes there reaches this degree of euphoria
Mhm.
where they just say, well, the world has changed. Nothing is the same. I mean, Larry Summers was saying secular stagnation. We're just never going to have high interest rates again. He actually, part of the thesis was never going to invent anything again. And so we're just never going to happen. I can't tell you how many people told me we would never have inflation again. I mean, I teach it in my courses. Now that's
Mm.
obvious, but until thanks to President Biden, we had this huge, I think he played a big role in this, had a
Mm.
big burst of inflation. So did the Fed.
Mm.
Um, I would ask my students about it, and they would just say, "Well, why would we want to know this? We're never going to experience inflation." It was like teaching the music of Frank Sinatra to them and saying it would be important to them. I go, "What?" You know, like, I think I would say financial crises were like that when Carmen Reinhardt and I worked on that book for 7 years. And a
Mm.
thesis was it could happen here. And
Mm.
people said, you're nuts,
Mm.
like you're just nuts. And
Mm.
famously, the Nobel Prize winner, Bob Lucas, gave a speech just saying, we have solved this problem. It is never going to happen. He did. And that was, he's very widely accepted. Many people thought that. Then people were saying it with inflation. Now people are saying it with debt. Well, I tell you what, we defaulted in the 1930s. That was a default when our bonds were guaranteed in gold, and we said, forget it. We're going to inflate, and we're not going to pay in gold. Tough luck. And of course, we did it again in the 70s. The idea we would never do anything, it's nuts. I mean, you do things when you have to. It's not, we'll do it when we have to. So this time is different mentality, these 50-year, 80-year cycles, journalists look at 3 years or 2 years and they think they're doing some long horizon. But there's so many things where you need to look at a very long period to have a sense of, as we say in the book with Carmen Reinhardt, you can't study 100-year floods with 25 years of data. And you need to look at long periods.
Right.
And I would say the same thing about debt crises, that just
Mm.
because nothing's happened for a long time doesn't mean it can't happen.
Mm. Did you come up with any predictive conclusions about how frequently debt crises happen? You looked at 800 years of data.
Uh, well, we were looking at, for advanced countries, it usually means inflation
Mm.
because we can print money. I mean, it's more complicated in Europe, but the
Mm.
US can print money. Although printing money is a salve. It temporizes because if you inflate down the debt, investors
Mm.
go, well, okay, great. I'm not going to take this low interest rate. I'm going to raise your interest rates. And then your problems just build and repeat themselves.
Mm.
But most of the defaults in history have happened from countries that owed money in dollars, owed money in gold. And, on the whole, we're just talking about sovereign defaults because there are lots of kinds of financial crises.
Mm.
They sort of happen. They seem to happen a cycle of every 50 years in emerging
Okay.
markets. It's not
Nice.
every 5 years. I think Venezuela is the modern day record holder, or they've kind of had one every 20 years.
Mm.
And Spain did that when it was an emerging market. Venezuela still has to get one or two more defaults before they catch up with Spain. But yeah, no, people learn. People right now having a banking crisis is hard because we just experienced one. We set up all these regulations. Everybody's sensitive to it. So, you don't tend to fight the last war.
Mm.
There are all kinds of crises, inflation crises, debt crises, financial crises, or private debt crises. And I think the next one probably is more in the public debt because that's exactly the one people say can never happen. It's absolutely impossible to happen. That's how you know that it could happen.
Are we on track for that, do you think?
Well,
I'm talking
inflation.
about America, United
Oh,
States.
no, absolutely. No, I think it's more likely than not.
Mm.
Our debt's gotten high, interest rates are high, our politics are divided. We are not resilient.
Mm.
And when we get hit by the wrong kind of shock, and I don't know what it'll be, but they seem to come every 7 or 8 years, these things. Uh, it's not every kind of shock. It depends on what it is, but I would say war would be the most problematic, something that required a pretty big buildup in expenditure. No,
Mm.
we'll probably do everything. We'll put in financial repression, more like that's what Japan did, by and large, Europe to some extent. We'll try to inflate depending on what's happened at the Federal Reserve. And I would not rule out, particularly on foreign institutional investors, some partial default. I mean, Trump's financial head of his Council of Economic Advisors, Stephen Moran, has this paper, the Mar-a-Lago Accord,
Yep.
harkening back to the 1985 Plaza Accord, which
Mhm.
advocates that. And he said, just kidding. We would never do that. Of course we would. If it's in our best interest, the United States will do what's in the United States' best interest. And sometimes what I call heterodox solutions that sound crazy, but in a crisis situation, they're not. Sometimes you have to do them. So no, I mean, I think all I say in the book, I want the book to be around for 20 or 30 years. So I try to be very measured. I mean, I think some of people may have seen Ray Dalio, a super smart guy, going around saying that, the sky is falling in, all the major
Yeah.
countries are going to default. And he'll be first, if he said that. I'm kind of more measured about that.
Mm.
He could be right, but there are many other possibilities. I would say having an inflation crisis, that's a very distinct possibility. Run up
Mm.
the debt, get rid of Federal Reserve independence. We're lining up
Mm.
all the ducks are in line to have that, and I think it's more likely than not.
And that's something that is more likely than not in the near future, is it?
I said 5 to 10 years in the book.
But you wrote the
Now,
book.
the book was finished just before Trump's election. I thought both
Okay.
sides were
Ah.
weak in this issue, so it didn't really matter if Harris had won. I don't think I would have changed a thing that I
Mm.
would have said.
Mhm.
But certainly watching Trump is certainly surprised in some good ways and some maybe ways I disagree with. And I would say 4 to 5 years now. Maybe not within his time frame, but
Mm.
4 to 5 years.
Okay, so I hope this isn't an unfair question,
Go
but
for it.
I'm gonna ask it anyway. So when you just getting back to this time is different and 800 years, and having looked at how economies do, or that economies do go through these periods of denial and complacency. And I actually looked at, I'm sometimes go through, gloom and doom spells, and
Mm.
was, certainly had that in the last 12 months or last 9 months or so. And so I decided to look back at crises since and including the Great Depression. So not national
Mhm.
crises, but just in terms of
Big
domestic.
one.
Yeah. And what I was looking for was, okay, if these crises are ultimately inevitable, what do the people who survive them and thrive even during them and after, what are they doing that sets them apart? Either both in preparation, but also during these crises. How does one prepare? See, this gets back to this idea that, so why should anyone care? They don't care because even if they understood it, like, what do you do anyway?
So I think investors are pretty smart. And investors, of course, they can be in a bubble, but let's take the stock market right now. It's just a good
Mm.
example. Is it too high? I don't know. I promise you we'll have a stock market collapse, I would say in the next 3 years.
Mm.
But will the stock market collapse to a level higher than it is today? I don't know. Famously, Alan Greenspan said this irrational exuberance. He said
Right.
the stock market was too high. And actually, the Nobel Prize winning economist Bob Shiller was the person behind this. He said it even before Greenspan did. And I'm sure, as many of your listeners know, if you sold when Alan Greenspan said it was too high, as opposed to just buying and holding for a few years, you lost a lot of money because the stock market went way up and it didn't come down that much. So investors play this thing. They understand the risks. They understand how to diversify. Your audience understands this very, very well.
Mm.
My work is also directed at policymakers
Mhm.
because the investors are, on average, getting a good return for the risk they're taking. The taxpayers are not getting rewarded necessarily for the subsidies they're going to give, for the recession that's going to happen. So the problem for the policymakers, I think, is a little different than investors. Investors say, show me the rules, make them transparent, don't change them all the time. We can make money. And that's great. But that doesn't mean that the policymakers should just run deficits to the moon, set interest rates really low when they shouldn't be. So a lot of my work I would say
Mm,
I have a lot of interest from investors, but
mm,
I'm not calling them stupid, not at all. Like,
mhm.
I think they get it right. And yeah, I mean, then we can tell all sorts of stories about the ones that, stayed liquid. Now, I myself, am not a great investor. I'm not, but I had one good trade, which is just before the global financial crisis, my wife wanted to buy an apartment.
Ah,
And I sold a lot of stock just before then. And, I didn't have the downside and was able to reinvest it when she decided not to buy an apartment. But I mean, that me? No, that was just my wife wanted to buy an apartment. And given the way
mm,
our finances and issues were, we did that. But I mean, these things are very hard to call.
mm,
Gold today gone way up. It's actually
mm.
I'm amazed. I think gold firms have bought thousands, I think even tens of thousands of copies of my book because it's quite constructive on gold as an alternative reserve asset.
Mm,
I don't go crazy about anything. I don't go crazy
mm,
about it. Is gold too high? I don't know. I
mm,
think that there's quite a lot of pressure on central banks to diversify away from the dollar. The euro is not ready for more. It's moving a little bit. The renminbi is coming, I think, over the next 5 to 10 years, you asked. Gold's here now. And
mm.
so gold's been benefiting. Will they change their mind? Will we have a crash in the gold market? I don't know. I mean, it's very hard to call these things. You're doing risk and reward. But again, for policymakers, for example, the heads of central banks, how do they manage risk? I think it's a different question. You're representing these disenfranchised taxpayers, these people who don't have any money, they don't have any finances. How do you
Mhm.
how do you manage them is a different question.
So, what do you make of the rally in gold? And by the way, I did see yesterday, for what it's worth, my metal holdings are silver. So I was delighted to see yesterday that it hit $60. It's mind
Wow.
blowing. It was 43 during the global financial crisis, and I thought I've still held on to it. I actually have physical. I shouldn't admit that, but I do. And so, but gold is it's this incredible tear at the moment, and it's usually it's a defensive play, isn't it? So how do you reconcile that with the strength of the stock market? Is this a bifurcation of the buying public? I mean, is what's driving this?
Oh, I think central bank purchases are driving it, central bank behavior, and not
Mm,
just now, but
mm,
projected into the future. A lot of central
mm,
banks would like to be holding more gold. And I think that story is pushing the price of gold up. I mean, I understand that central banks are actually a small component of demand in some ways, but I think
mm,
that story's not going away. That story, you can play it out for 10 years.
mm.
I actually, if I had a gun put to my head, would probably say gold's more likely over the next 10 years to go up than down because I think it's going to take time to diversify away from the dollar. So, that's certainly a part of that story. But in general, of course, all asset prices have been on a tear.
Have you seen, or do you look at the behavior of retail investors and their influence on the markets and on gold as well?
I mean, not like you do. I mean,
Mm,
I'm a macroeconomist, and so, but I'm very aware that retail investors have been pouring into gold. All you have to
mm.
do is turn on the TV, and there's like a gold advertisement, every hour, and that's telling you that retail investors are pouring in.
Right. And when your Uber driver recommends it to you as well, as you also know
Did
something's
your
going
Uber driver recommend gold?
just what was it? Somebody was it JP Morgan or somebody said that when his driver's shoe it was his shoe polisher,
Right.
right?
Yeah, no, that's a famously, yeah. No, that's it's good measure.
Started giving him tips. Exactly. All right. So you've also talked about the impacts of deglobalization. So what is the impact of deglobalization and how can policymakers Oh gosh, we've been talking for almost an hour. I can't believe it. Okay, so let's just maybe move to wrapping up with. Actually, let me ask you this question to wrap up with, because I really don't want to take too much more of your
Thank
time,
you.
Professor. Seriously. All right, so I have to ask this question, particularly because it is a term that is used so frequently in the commercial real estate world, and that is, and we talked about it a little bit, but as we go into 2026, do you have optimism or pessimism, and how should investors position themselves? And of course, underlying that is, should we be confident? Is this time different?
So I think the big shock that we kind of know is going to come, but we don't know, is it 2026, 27, 28? There's going to be a stock market crash. I mean, it's going to come. It's not necessarily overvalued. It's just whenever you have a new invention and you don't know where it goes or where it should land. So I would put that as a 1 in 3 chance in 2026. There's a chance it's going to boom. I'm not telling you to sell all your stock. I'm not selling all my stock. But if you want to know, if you tell me we got a big shock that wasn't a war,
Mm.
that's the one I would point to. Um, the thing that surprises me, and I think will change in 2026, is that volatility is so low. We live in this world that's just crazy. I mean, it's not just the politics, it's also it's not just as crazy, unpredictable. AI, where's it going? I have no idea. Where's deglobalization going? Where's everything going? I mean, everyone, I think, would agree that 2025 was a year with some big shocks where the most surprising thing was it wasn't more volatile. Who knew?
Yeah.
I think, and we see that in market measures. Market measures of volatility look like they're asleep a lot of the time. I think that's going to change in 2026. So there are sophisticated investors, again, like your listeners, that tell me they were, you know, trying to hedge their bets by investing in funds that would benefit if there was volatility. And they were dogs. They all lost, no insult to dogs, but they all lost money. They all lost money on these things because there just wasn't any volatility. I think that's going to be a good trade in 2026.
Professor Kenneth Rogoff, Professor of Economics at Harvard University. Thank you truly for joining me on the podcast today.
And thank you for having me on your podcast and getting to speak to such an elite audience.
All right, that was Professor Ken Rogoff of Harvard University. Professor Rogoff, thank you so much for joining me today. I really enjoyed our conversation. Cannot believe how fast it went. So I really do appreciate the time that you spent with me and for sharing your insights. I've enjoyed listening to you and following you particularly actually over the last year, although I did buy and read This Time It's Different some years ago. And thank you too, dear listeners and viewers. I hope you've enjoyed this special edition of the Real Estate Market Watch podcast. And I wish you a very happy and healthy New Year and holiday season and New Year. And I will see you in 2026. But for today's episode, this is Adam Gower signing off.